Hi, this is Bryan Rich from Money Markets TV. About 2 months ago, the S&P 500 was riding high, trading close to its best levels in 2 years. But it wasn't warranted. I've said that we should expect more pain in the markets and that the economy will likely be in such bad shape that we may see the Fed institute yet another round of quantitative easing. It's now clear that this scenario is playing out. The global sovereign debt crisis continues to grow more severe. The contagion in Europe has spread now to Italy and Spain, two countries that are too big to be rescued by a magical bailout from the EU and the IMF. And now the United States has been downgraded. Until now, most investors and politicians have done their best to ignore all of this evidence. But as I pointed out many times, this so-called recovery is following the same pattern as every major financial crisis in history. Anyone paying attention could have predicted that it would lead to a sovereign debt crisis. According to economists Carmen Reinhart and Kenneth Rogoff, during sovereign debt crises, we typically see rising deficits, rising debt, an onslaught of downgrades, and finally defaults. In addition, they showed that the type of credit buildup that led to the financial crisis usually takes a decade to unwind. So we're not even close to being out of the woods. If we look at some key economic indicators, it's clear just how dire the situation is. U.S. economic growth during the first half of this year is running less than 0.75% annualized. Keep in mind, that's after record fiscal and monetary stimulus. Meanwhile, unemployment remains above 9%, and the 9 months of job gains are now heading back toward job losses. Then there's the housing market. Home prices fell to a new low in March and remain 32% off of their 2006 highs. That's despite all of the failed government rescue programs. Given this backdrop, global financial markets are going to have to adjust to this new economic reality. And last week, we finally saw signs that they're doing just that. The S&P 500 broke the key trend line that represented the bull market that's been in place since 2009. And that could be the beginning of a retracement back to 1100, 1020, even 940 in the S&P. In crude oil, the chart looks very similar. The breakdown in its long-term trend line opens up another big decline if the global economy continues to unravel at its recent pace. Those two indicators paint a gloomy picture for currencies, especially the Australian dollar. It's one of the currencies most vulnerable to global risk aversion. That was clear during the first round of the financial crisis when it fell 39% in just 5 months back in 2008. Now it's breaking a long-term trend line of its own. After last week's stock market rout, many people now think the world looks like a scary place. But the fact is, the global economy has been a scary place for 4 years now, and all the evidence points to a continuation of that trend. We should always seek out investment returns that compensate for risk taken. And in this environment, which is highly vulnerable to economic shocks, not many exist. That's why I continue to think we'll see another aggressive flight of global capital back to the United States, home of the deepest capital markets and the most liquid currency. It's important to remember, in crises, capital preservation is king. I'm Bryan Rich from Money Markets TV. Thanks for watching.